Hi, everyone. I'm Rick Bensignor. Today is Tuesday, July 26th, and welcome to this week's brand new In the Know Trader show. I thank you for joining us and being a part of our launch episode in the sense that I am now doing these on my own through my own YouTube channel. And I appreciate you being here and joining me. So let's take a look at what we've got on tap. We'll start off by talking just a little bit about the new In the Know Trader channel and what you can expect from us. We'll continue with our trader education portion each episode because it's something you tell us that you truly appreciate and have a hard time finding anywhere else. Just the consistent ability to get someone with 40 plus years experience in the markets, their knowledge and the experience that I bring to the table from having traded for so many years and also having been on the sell side on Wall Street and of course the buy side. It's a very nice combination of skills I have, having done this for so long. In the trader education portion, we'll talk about why In the Know Trader has a dominant edge in the market relative to other type newsletter services. And then we'll continue doing our sector focus each episode too. And today I thought it made sense to take a look at the energy sector, which has come off hard over the last few months, but still is the best performing sector this year. So we'll take a look at the XLE, which is, of course, the SPDR ETF that tracks the S&P Energy Index. We'll look at it also versus the S&P itself, so we see relative performance. And then we'll finish up by taking a look at the top 10 XLE holdings, starting off with Exxon and going through the names that you see here as with a good likelihood that if you're in the energy space, you may very well own one of these names, which is, at the top of the weighting in all the names in the XLE. Let me give you also a little bit about what In the Know Trader does before we start talking specifically about the new channel. So you can sign up to get my weekly ETF report. It's the Tactical Trader. And we also come out with a monthly 7-Eleven report. So let me tell you, the weekly ETF Tactical Trader goes through the entire macro view of the market. We look across all 4 major asset classes. So we do a deep dive into what the S&P is doing, what I think is happening in bonds. I often comment about credit markets and the influence they have as far as helping to determine which way the equity market's likely to go. We'll almost always take a look at the US dollar index and the implications of what has been a strong dollar for this year. We'll look often at commodities like gold and oil, the 2 most important ones. Often, even recently, we've been looking a fair amount at natural gas, simply because it's moved up so much. And of course, a lot of that has to do with the US prices getting dragged higher simply because of nat gas spike high prices over in Europe because of Russia decreasing the flow of gas. So both these reports are available at intheknowtrader.com. The 7-Eleven monthly report, the next one will come out this weekend. It's August 1st, coming up in a few days, and you'll always receive the night before the new month starts, our latest issue. And what we do in this report, the 7-Eleven report, I started at the end of this month. It'll be precisely 2 years ago. And the goal of that report is to outperform the S&P by investing in no more than 7 of the 11 macro SPDR ETFs at any one time. So, the S&P is broken down into 11 sector groups like energy, financials, technology, consumer discretionary, consumer staples, healthcare, etc. In order to beat the S&P, which is the goal of virtually any portfolio manager who's benchmarked to the broad market, you've got to be in the right sectors at the right time. And the goal here in the 7-11 report is to stay away from the non-performing sectors as best as we can anticipate what's coming next. So we'll put you in no less than 5 and no more than 7 of the 11 SPDR ETFs for each month, with the goal of outperforming the market. And to give you a sense of how we've done, these stats are through June 30th. They'll get updated at the end of this month. But in the first 6 months of the year, we are outperforming the S&P 500 SPDR ETF by 310 basis points. And we have outperformed every single month this year. In the 23 months that we started, we're outperforming by 7.61%. So other than when we update at the end of this month, we're going to be probably somewhere at 7% or above outperforming the S&P in 2 years. And in the money management industry, that puts us in the top 10% of all money managers. Now, as you know, I'm not actually managing your money. It's a market newsletter. I tell you how to position. So you're still in charge of your money. At some point soon, I may start actually managing outside money because of certainly the track record and success of this piece. But you're in control of everything. But if you can outperform, and you would exactly mimic what we're telling you to do, then you can outperform based upon these results. You would have outperformed by 7.6% coming into this month over the 23-month history that we've done this product. And again, that without tooting my horn, that I'm just telling you statistically, that puts us in the top 10% of all people who do this. So for a very small price each month, you get to reposition no more than 7 of these SPDR ETFs in proper proportions in order to beat the market. So if you have money, if you're an individual investor and you have money in SPDRs, right, you just want the broad index return, you'll do far better being in this. If you're a financial advisor and you have clients who are in passive index funds, you will do much better in this based upon the results that we already have than if you had been in the SPDRs during the same 2-year holding period. So this is something really to consider. And we have a large portion of subscribers are financial advisors. The bulk are still individual investors, but we probably have about 1/3 of all subscribers are financial advisors. So this is something that can be a very helpful tool to help you manage money for your clients. Of course, we're starting the In the Know Trader channel effective today on YouTube. And the link to follow it is the following. And just as a reminder, if you're copying this link, that says 0 here at the far end. It's not the letter O, but it's actually a 0. All right. And Twitter, if you want to follow me on Twitter, it's at In the Know Trader. Okay, let's go back here and just get back to the new In the Know Trader channel and what you can expect. So in the new channel, and again, I've left stock charts where for 3.5 years, I've put my weekly show on their channel. I've now decided to do it on my own. What you can expect is, we will continue doing the education portion. From what you tell us, it is the single favorite thing about the show that drives you to our channel and to the shows I've done. So I will continue as best I can, each episode coming up with something new, or perhaps revisiting something I spoke about years ago, in order to continually educate you on the best way to trade, the best psychology ways of approaching the market, and essentially understanding models in a better way than you might possibly on your own. So if you're watching the show, you might very well be a student of technical analysis, but I will show you often how to use indicators in a much better and effective way for making money than you would by listening to the textbooks on how to use them. It's just one of the many ways in the trader education portion of the show we give you somewhat of a better edge compared to what's out there. Of course, we use different models, and let's talk about that for a second. So, what helps give us the edge, and why we have essentially a dominant edge in the market like we do for as long as we do. And I've been doing this institutionally since the mid-1990s. I still have institutional clients from back then who subscribe to my institutional report, which is a separate business I have, not intended for the individual investor, but for the very sophisticated institutional client. I have people following me for that many years because I am known on the street as being one of the most consistent strategists and trading-oriented strategists who helps clients be able to spot market turns before they're obvious to other people. And I've said this before, and I'll say it again. If it takes you 15, 20% off of the high or low before you first realize that a new trend has started, then you've missed the real chance of outperforming. Because once you played the trend, when it's an obvious trend, you're doing what essentially everybody else is doing. And you're let's say, buying an uptrend in an established uptrend. Well, it's pretty hard to outperform the index when you're first getting long something that's already proven to be a strong uptrend. The smartest money on the street makes the most money that they do because they're properly positioned at the turns. When a bull market stops being a bull market and they get positioned for the potential move to either sideways for an extended period of time or a downward market, so they've sold out before negative price action comes in. A market that's been selling off and is a continual bear. For instance, what we've had this year, how and when to position for that not likely to be the case. And just to give you an example, back in March, I went out and told my clients and those who follow In the Know Trader that my projected downside move in the S&P for 2022 was to a level of 36.17. And the low for the year in June ended up being 36.37, 20 points away. And obviously we're several hundred points higher at this point. And I'm not convinced that that low ultimately stays the low, but we've been playing bullishly since then, in almost all cases, because we could, before it was obvious, we're able to get long into that level and play for a bounce before everybody else now looks and goes, well, that looked like the low. That is how you outperform. And that is really what my research has been about for 25 plus years, that I've been publishing on the street and putting out and talking to some of the most successful hedge funds and mutual funds and pension funds in the world, and continue having done. I think I started this back in 2000 and maybe 17. I think I started In the Know Trader, so that the individual investor can get access to models that you cannot find. And if you can access them, you'd never understand how to use them that institutions use, and why, in many ways, they continually have an edge over the individual investor. So I try to level the playing field for you to give you what those models are saying with my interpretation of them, because even somebody who learns the models fresh now could take years to fully understand how to implement them. So as a client, you get my expertise in that. Other things that we're going to bring to the channel, potentially I will do some interviews with some well-known people in the street and give you an inside look into how some other professionals feel about the markets. And I probably won't do a ton of those, but at select times, I may very well call a friend or somebody and say, hey, look, I'd like you to give me 20 minutes of your time so that, you know, we can do a video together. And I'll continue to do this weekly focus on a sector, or sometimes I do the most popularly held stocks, whatever it is. I'll try to give you an insight into something else that we're looking at in the market, and get down to individual stock level and look at the charts and give you my interpretation of what we can expect. So that's a little bit about the new In the Know Trader channel, and I've already combined that into why In the Know Trader has the dominant edge in the market. And I can tell you, lots of other people in the industry send me their newsletters, their market newsletters, and I see the type stuff that they put out. And so often their bottom line is simple technical analysis, like stuff that's so simple, basic indicators, RSI, stochastics, Bollinger Bands, Fibonacci retracements and extensions, and where they think they have a real edge. And the reality is, and many of you, I've said this recently, I often will mention this at conferences that I speak at, and I'll have people raise their hand and say, how many of you use, you know, are technically focused? And most hands go up. And how many look at the RSI? And most hands go up. And how many look at Bollinger Band? Same thing. And, you know, all the basic stuff, and everybody's hands go up. And I say to them, that's great, except guess what? Most institutions couldn't care less about those. Even the technically inclined people couldn't care less about those, because that's not what's driving their decision-making process. They're looking at models that much more align with the ideas that I'm saying about being properly positioned for turns, so that you're still buying into when they're selling. And you have people on TV saying, oh, look at this bull market, and look, it keeps going, and it's breaking out to a new high. And meanwhile, institutions are on the other side of your order. The models that I use, I have taught, not only are predominantly used in the institutional community, but in my 20-year career, or it's more than 20 years that I was, let's say, on the sell side, going around to clients, I have taught hundreds and hundreds of institutional clients how to use these models. So I've also become the de facto go-to guy on the street for interpretation of DeMark models, for interpretation of how to properly use Ichimoku. Most people out there still don't use it correctly. I see people on the business news channels talking about it, and they've got at least half of the interpretation of how to correctly use the model wrong. So what you get from me is the person who mostly introduced Ichimoku or cloud charts to the Western world, and have taught more people than anyone else how to properly use them. So that's all part of what you get. Being a subscriber to this channel costs you nothing. This is my giving back and providing education to the individual investor, so that you can do your best to compete against institutions and remove the edge they have in trading. All right, let's get to some charts. Let's start with the XLE. So here's a chart of the S&P Energy Index ETF, XLE. For those of you who are brand new, you're going to see some models here and numbers on the charts you may never have seen before. At some point, I may do some videos on how to interpret these, but otherwise follow along and understand that when you see blue 9s, or in this case, pink colored 13s, they often indicate exhaustion of trend. If they come above the price bars, that would tell you that it's suggesting exhaustion of uptrend, or certainly a time in which buying into the trend comes with far more increased risk than typical. If they come underneath the price bars, as they did, let's say here in 2020, this 13 is suggesting downside exhaustion, a really poor time to be a seller in the downtrend. And for those who are more counter trend inclined, as I generally am, it's often a signal to help me start looking to be a buyer. You'll notice that the highest high here that we had this year came also on a weekly 13. Generally in this, in the No Trader shows, I use weekly charts as a default, just to kind of give us a medium-term view of what's happening. I drew this hyphenated purple colored line here, this deep purple, just to show you that what ended up being 4 prior highs early this year, weekly highs, has then since come back to be a low here in March, a low again in April, multiple lows in the spring leading into the summer, and just one weekly close beneath, which then instantly popped up. So it hasn't really broken down, despite the fact that, again, if you were looking at this, the real interpretation of this is that it didn't break down. Many will have sold either times during these weeks, having been beneath these levels. But from a more expert eye, one single break beneath a level often is not enough to get me to actually say a level's been violated. On the upside now, we can look for resistance near 79.5 over the next few weeks. And importantly, too, is that we held the uptrend line. So despite the fact that energy has had a very tough few months, it is still holding its basic uptrend line, and it has not truly broken down. So put that into the context of how you look at things in the scheme of things, and whether or not now's the time or place to be that you might be interested in buying. Let's also look at the XLE versus the spiders, because this is now relative performance. And we're going back multiple years here. And I've got 3 trend lines coming down. This from 20-year highs, which probably came 8-10 years ago or so. These are downtrend lines, all off of highs or the subsequent, the interim high since then. So we still have a fair amount of room to work with on the upside. And this is kind of a basic chart that most people would look at. So I put a channel in here. I drew a trend line off of the low and then picked the highest spot in between the 2 points I drew the trend line to draw a channel. And you notice that, we kind of got close and started bouncing again. But let me show you, again, some of the difference of what we bring to the table versus your average technician. In terms of relative performance, the XLE got to be almost 23% of the spiders and sold down to, let's call it 18% of the spiders before getting a bounce. In percentage terms, 23 to 18 is 5. That is in the neighborhoods of at least 20% decline in relative performance terms, meaning 2,000 basis points of giving back the outperformance that it had seen. That's very significant. Well, how would you have been able to spot that? Most technicians wouldn't have. What we showed you at the time, and why on June 1st, I lowered our overweight exposure in the 7-Eleven newsletter from a very heavy overweight in energy, which, by the way, we went, I'm going to circle it here so you can see. We went overweight energy here last summer. And We increased size over time. I got to more than a 2 times weighting relative to its benchmark in the S&P, and we lowered it by 30% right there. That's the difference in understanding how to go counter trend versus simply playing the market. We bought when others were selling. We sold when others were buying. If you waited to first, this happened so quickly. If you first wait now to sell and reduce your exposure in energy names, again, it's very hard to outperform because of how much this is sold off. If you waited for these highs, you had to go into January, February of this year before you broke out of this inverted head and shoulders pattern. So if I drew, let's say, a neckline here and said, so let's just make this a different color so it's easy to spot. We'll make it bright blue. So right here's your inverted head and shoulders. In fact, there's almost another inverted head and shoulders within this one. If you waited to January, February to buy the breakout, you've made money, but you didn't make nearly as much if you got long here on the pullback. How did we help time those? Because this is a big function of market timing. So now I'm putting up some of these DeMark models, and I mentioned 9s and 13s are often where trends exhaust themselves. So we got long energy here as an overweight, and we reduced 30% of it here. And just a week ago, I started getting institutional clients just a tad more overweight. Nothing close to how much we had here, but we just put on a little bit more with my thinking that we're getting closer to a bottom. I can't necessarily identify that this is a more assured bottom, but I was willing to put a little extra energy weight on. I think it was, what day is today? Today is Tuesday. So it was actually, I'm trying to remember if it was yesterday or a week from yesterday. But anyway, very recently, we put a little bit back on. So here's the chart of energy versus the S&P. And what I'm going to do now is just kind of condense this so you can see even more price history. And what you end up seeing is just how bad a sector energy has been to invest in almost since the beginning of when. Let's see if this will let me bring in more. Okay, so I can't do an interim. So it looks like, well, here's your total trading history since XLE started trading in the late 1990s. This is how it performed versus the S&P. So you went from 1998 to 2008, that energy was a massive outperformer. And since 2008 into 2021, massive underperformer. And now you had the massive spike up. And notice this came before, some came since the Russia-Ukraine war. But again, if we went overweight last summer, that is way before. And we're still now essentially, if we take a look at what had been all-time lows, which was just after it started trading, we've shot above it, and we're potentially getting closer to also a place that you could look at as the swing area on the near-term chart. Just as far as, are we going to stay above, or are we going to get back down in here? My belief is that energy, and I said this at the time when we went long in 2021, that energy has made its secular bottom. So the 2020 low, to me, is the low that's going to stay the low in the sector. So I do think that energy has a place in your portfolio. It's been a big place in our portfolio since last summer, and that we are not going to revisit these lows, so that it is a sector to continually think about investing in over time now. Let's look at some of the individual names that make up the sector. So we'll start with Exxon, the highest weighting. And we're going to start here with kind of a simple chart with the same lines that anybody can draw, and then we'll add some more of the models that we like to look at. So this high here was the all-time high in 2014, and you'll notice on the spike high this year, we essentially tested the all-time high at 105, and we've pulled back. We also look at where the low was in 2015, and we see that was the low in late 2018 when the market came apart. We tested that, rallied. We then eventually, and tested it multiple times before the COVID sell-off put this all the way down to a $30 stock off of a 105 all-time high. You see the test of the lows, the move back up to that level, the pullback, and then we broke through. The trend line is still intact. But now, so this is, again, that's, in a general sense, you're kind of in between two major areas here, all-time highs, and then this transitional area, let's call it in the mid 60s. What else can we add to this that potentially helps us here? Notice when I put up the sequential model, and again, this is when I told you 13 and 9s are things I look at, but it's a far more complicated model, but I'm trying to give you a quick look into how and why we make some of the decisions we do that appear at the time we do them to be very counter-trend and against conventional thinking. You can understand how and why we turn bullish and why we recently made the high, and while everybody else is talking about that this is going to break to new highs and that with oil potentially going to $200 a barrel, this was going to go, and I'm like, this is probably the place not only that you don't want to be adding, but if you're long, you want to be selling calls against, you want to start hedging your positions. If you're very aggressive, you flip your book and go negative, but at the very least, you want to do something negative. So that's the, over the recent few months, the picture. Let's see also what cloud charts are telling us, what propulsion is telling us. So looks like we had a couple weekly closes beneath the baseline. That's generally not good. It would suggest a potential top now against the conversion line here in pink at 93. And as long as you're above 78 and high change, this is still good. If you take that out, then we're probably going to test the trend line and the cloud. So in general, Exxon still looks good, but we're still within the context of a recent 13 signal that suggested potential end of trend, and we're consolidating in here. My guess when it comes to oil itself, we probably trade between 85 and 125 for months and months to come. And barring a significant change in the fundamentals coming out of most likely the Russian-Ukraine crisis, and I don't think Russia's in any mood to shorten this war or come to peace with the Ukraine, despite some of the crazy calls that some Wall Street firms have made over the last couple of weeks, including one firm saying $55 oil and another saying $200 oil, if not $300 oil. I actually think that oil is trading exactly at its long-term equilibrium price. And of course, it can trade around its equilibrium, but I think that you're probably not getting much beneath 85 and not above the 125 level. Once we made the 130 high this year, it sold off. It came all the way back to 122 and then fell down to where it is now. So you really have a good double top this year. And even if you looked at crude oil over its entire trading history, the 130 top we saw this year is probably an effective test of the all-time high at 145 from years back. So I'm kind of in the camp that oil is going to do its thing, but it's going to rotate around the mid 90s, $20, maybe either way, but more likely not getting 20 on the downside, but maybe getting back up to, the upper 110s or into the 120s. But without a fundamental change, this is all going to be rotation because of how people are positioned and how they react to near-term fundamentals. But if you don't change the long-term fundamentals, I'm in the camp that oil's not going to make the big move either direction that most people are calling for. Let's take a look at Chevron. Chevron, a similar picture, got a 13 exhaustion signal a little earlier than Exxon did. This came in April. I think Exxon's was a bit later. Nonetheless, we've also had some multiple closes under the weekly baseline that does put resistance back up near the upper 150s. And on the downside, if we get one more leg down, we're probably going to go and test the cloud. So similar looking picture as I generally would expect between those two. Occidental, OXY, did not get an exhaustion signal. It's just played with its conversion line here and has not reached down to underneath the baseline the way the other ones did. So this is actually technically a stronger name than the other two big kings that we saw, the Exxon and the Chevrons. Oxy's actually a better chart. So in just keeping that in our heads as we look through some other charts, we at least have the best of the three we've looked for. This is probably the weakest one in the sense that we've gone all the way down to a propulsion exhaustion level here. In fact, that's a full exhaustion level. So we bottomed right into an anticipated low and have bounced. Now look for resistance 101 to about 104. You've got to get multiple Friday closes above 104 to then go aim for about 130. Conoco, oh, that was Conoco. So let's do EOG, sorry. Same thing, exhaustion on the high, pulled back close to the cloud, hanging in here, has hit its downside target, or at least one of them. You need to get multiple Friday closes above 122.41 in order to get this back bullish again. Otherwise, you'd still be a seller into a rally and look for still a potentially farther down move. It doesn't have to be, but while we're on the 7 count, I know this could easily get to a 9 over the next few weeks. So still short term, some pressure in this name. Schlumberger, SLB, has already hit its cloud and its downside targets. A tradable bottom from there for those who understand this, and more as you tune in each week, you're going to learn how to incorporate these models into what you do. Resistance now from about 40 to 41 or so, and what medium-term holders certainly don't want to see is any move back under 25. Otherwise, this is still in consolidation mode after the big run-up. Not a name that I particularly want to do a heck of a lot with right now. If you didn't buy the low a few weeks back, I don't think I'd come in and chase after that now. PXD is Pioneer. Again, similar looking chart. However, this didn't have the exhaustion signal on the high from the DeMarc count, but it did stop at a propulsion exhaustion level. So that's now broken down. Again, look for resistance probably somewhere in the mid 240s now. It's trading 219-ish. And if it gets another leg down, this is going to test the cloud and break under 200. Marathon MPC. Same thing, didn't have its exhaustion signal. Hit a couple of longer term upside propulsion full exhaustion levels on the way up. Broken down, resistance now kind of 90, the mid 90s, and a next leg down takes us all the way down to 70. So still a name that's potentially vulnerable for another decline. Valero, VLO. Stopped at its propulsion exhaustion level. Look for resistance now anywhere from 113 to about 122. Needs to get above 126 on multiple Friday closes for it to turn fully back into bullish mode. And lastly, Phillips 66. Don't love this chart. Very choppy. Topped when most of the other ones did. And other than the fact that it kind of has close to a double bottom recently, I don't know. Right now, I'd say resistance 93.5-ish. And you'd have to get multiple Friday closes back above that. Actually, we're on an 11 towards a 13. Even if it did that, I'm not sure I'd want to do it. So this is not one of the better names in the group to look at. So there it is, our first show. And, I'll try to change things up as we go. Please write me at rick@inthenottrader.com. That's my email for suggestions on things you'd like to see. And I welcome feedback and will always answer your emails. Be courteous. That's all I ask. Even if you don't like what I'm doing, be courteous and tell me so. And tell me what you'd like to see to make this better. So that's it. I hope you enjoyed our show. I'm Rick Bensignor, and this has been In the Know Trader.